Welcome back. Today we are talking about the hot and juicy redhead herself, Wendy's, which is one of my favorite clips on The Office. Anyway, this one, I really didn't expect much. I keep up with all the trending stocks and stuff because you never know where a good idea is going to come from. And just because something has become a meme stock doesn't necessarily mean it's not fundamentally strong. And this one was way more interesting than I thought. I'm going to run through some of the financial statements, talk about, why it might look really good, talk about the asymmetry, then look at some of the competitors. So anyway, let's get started. So what I want to start with Wendy's is the free cash flow, because if you look at this, it looks so cheap on first glance. Let's see, free cash flow, 5 years, or I can do rolling trailing 12 months for the last 10 years. So, 200, let's call it 250 million, 220. We'll do 220 on a market cap of 1.5 billion. So that yield is more than 10%. Just going to the valuation real quick. I usually do this at the end of the video, but I want to start with it because I think it's really interesting. I'm going to put my starting free cash flow per share. I'm going to pull it from up there. You can also input your whatever number you want. And just look at this. Normally you put your growth rates here, you put your long-term growth rates, you put your discount rate and your margin of safety. It could have zero growth over the next 5 years and long-term. So it literally just, if I expand this to see the free cash flows, just sit at $1.17 per share. And it's still undervalued from a pure DCF discounted at 12%. It could have negative growth on the low side. And even in that scenario, if the share price shrunk on the low side to less than $1 a share, you still have 94% of the scenarios in this simulation say that the stock's undervalued. And just in case y'all aren't familiar with the channel, the way this works, this is basically a Monte Carlo of all these inputs. I think it's like 20,000 runs or something, and it plots all the findings on this, and then shows you how many fall above or below the current stock price, and then how many fall in this deep value zone, which would be the current stock price divided by 1 minus your margin of safety. So if you were to put 0 here, it's just all green or red. And honestly, with the asymmetry on the short side, even though there's some serious red flags on the balance sheet that we're going to talk about, this was enough for me to buy some. So anyway, let's talk about the balance sheet and some of those red flags. If you go to the balance sheet, the debt. So let me hide this information. Go to total debt, and remember the market cap is 1.5 billion and you have 4 billion of total debt. Your total liabilities are like 5 billion. That's kind of hard to stomach. And if you dive further into the debt, another way to look at it is this interest. So you go to the income statement, you can go to net interest, and you'll see that it's minus 125. So compared to free cash flow, that's pretty significant, right? And what I like to do, and if you're on the website, you would go here to custom metrics. And this website is open for anybody. There's a free version, premium version. This is special launch pricing. So if you want to join up, follow the link. There's a lot of good tools here that I think make it a great valuation and stock analysis for anybody. The goal is to make it extremely intuitive, extremely simple. So check it out. There's a 14-day free trial, which is a long time. So what I'm going to do is create a custom metric, which is a great tool because, there's a lot that the financial statements tell you, but I feel like the real analysis comes from taking pieces from here and there and seeing what's actually going on, right? So here's interest divided by operating income. I'm going to make it negative. Let's see, interest. Because interest is a negative number divided by operating income. And what this shows you, and then I click to make it a percentage here, save it. And what this shows you is what percentage of your operating income, and I'll switch it to quarterly, is going towards interest. And honestly, I like this to be as low as possible. I'm talking single digits. So the fact that you have hovering around 30 to 40, and then recently 53%, that is a major red flag. There's no other way to put that. That's real risk. It's probably why people have shorted it, because if you have a lot of debt and your interest as a percentage of your operating income is that high, it's just danger zone as far as if you start having a few bad years, just it tightens your turnaround window, right? And I know that that's what they're working on, but that kind of stuff is scary as an investor, right? And if it wasn't for the asymmetry with the potential short squeeze and all the volume and hype around it, this would be enough to make me say no. But I think it's a little more interesting than that. Real quick, I'll do another custom metric. Something else I like to look at is, let's make one, is the free cash flow divided by the total debt. No, I'm sorry. Total debt divided by free cash flow. This would be like if they were going to pay down all of their debt, total debt, how many years would it take them based on the free cash flow that they're generating right now? So total debt divided by free cash flow. It's not a currency. So you see here, it's like based on the free cash flow. I mean, it's going to take them 15, 17 years to get rid of that 5 billion at the current, or 4 billion at that current free cash flow rates. So that's the story with Wendy's, right? It looks extremely cheap at first glance on a free cash flow multiple, earnings multiple, dividend yield, which with that much debt, I'm shocked that they're paying a dividend like that. Let me go back to this. So financing cash flow, I'm sorry, their free cash flow was what? Like 243 million. Okay, so of that 243 million on an annual basis, how much of that is going to dividends? So in financing cash flow, dividends paid 130 million. So yeah, to me, this is just extremely risky. I know a lot of people are buying this because they say, well, worst case scenario, I'll lock myself into an 8% dividend. I would not count on that. If I was the CFO, this would be the first thing that would be gone, because you need to ensure the health of the business. And whenever you have that much debt and you're working on a turnaround, the way that you do that is not by siphoning off, $120 million a year to out of the company in the form of dividends. I'd much rather see that in buyback. Buybacks are kind of risky too with that much debt. So maybe just debt payment, and they're not really doing that. So anyway, last thing on the debt, because this is another metric I like to look at. Now, it's not exact as far as finding the interest rate, but I kind of, if you take your interest expense divided by your total debt, you kind of get an idea for what kind of interest they're paying on it, and it can let you know if they're in a bad spot or good spot, or what would happen if rates change, that sort of thing. So interest divided by total debt. You know what? I'm just going to call it interest rate. I'm going to call it interest rate. It's approximate because it's just kind of our way of using that two metrics to come to a conclusion. So negative interest expense divided by total debt, and that is a percentage. Oh, I don't need the minus sign. All right. So look at this interest rate. I mean, it seems really low. 3%, 3%. Back here it was 4, which seems more realistic, especially with higher rates, right? But maybe there's something going on in how they're financing it that they get these low rates. But if rates increase, this is a huge risk, because your interest rate, your interest payments are already, if I go back to interest payments, they're already 125 million. If their normal interest rate winds up going up even 1 point, like from 3 to 4, then you're increasing from 125 to, let's see, 125, divided by 3 times 4 to 166. So it's a huge, to me, that's another big risk. And it's honestly, well, I'll do my conclusion at the end. I'm going to show you some other companies because I thought this was interesting. So I'm just wanting to look at competitors. Okay. So QSR is another fast food brand, Restaurant Brands International. And this is one that a lot of super investors own. Bill Ackman, I don't know who else. I think Seth Klarman. And they are Popeyes, Burger King, I think Firehouse Subs. But anyway, the big ones are obviously Burger King and Popeyes, which from a food quality and service especially, Popeyes and Burger King have nothing on Wendy's. They're to me they're kind of equal. I know that there's feedback on Wendy's service side and their food's declining. It's not. I mean, that's their equivalent with Popeyes and Burger King. Nobody's even close to Chick-fil-A's level of customer service. And what I wanted to highlight here is just the multiple and the debt loads on all these other companies that people like. So PE's 20. They're if I go to the custom metrics, it saves what I had before. So if I look at how many years to pay their debt, it's still 12 years. I think Wendy's was 17 or 18. So it's not. I mean, it's better, but it's not like these other companies are operating with zero debt, right? If I go to Yum, which is, let's see, Yum is KFC, Pizza Hut, Taco Bell. Similar story, 25 PE. Their debt load is significantly lower. It's only taken 7 years to pay off, but it's not like these companies are operating with no debt, right? McDonald's, I think similar to Yum, high PE and about in that 7-8 range on years to pay back their debt based on their free cash flow. So in conclusion, I understand the short thesis. I understand that they're set up worse on a balance sheet standpoint than their competitors, but they're so much cheaper. And there's so much pressure on the short sellers that I think the asymmetry makes it worth it. And I do have a small position. We'll see what happens. It's not my typical investment, but I think it's a very interesting story, and I'm excited to see where it goes. Once again, if you want access to the website, there's a link in the top pinned comment. Sign up, do the 14-day free trial, message me, tell me what you like, tell me what you don't like. Just use this little box here at the bottom. And our goal is to make this the one-stop shop website for value investing. We have some major plans down the road, but in order to do that, we need to build up a strong user base. So thank you again for watching. Check out the website. Have a great day.